Hello, this is Bill Nelson from the Bank Policy Institute. I'm here with Francisco Covas, the head of research at the Institute. So Francisco, this upcoming Friday, next Friday, the Fed's going to be announcing the results of its stress tests. What's different about the stress test this year?
Obviously, the first thing we want to look at is the impact. So the scenarios are very much more different this year. We have the macro scenario itself. There's some series that are more severe than last year, others are less severe. So overall, we just want to see what the outcomes are under the different scenario. We also, another important aspect of this year's stress test is that a larger number of firms are going to be subject to the global market shock and the larger default contraparty components of the stress test. So that's also going to be interesting to see what the outcomes are going to be like. Also, the Fed made several changes to their models this year. So that's going to imply different projections for losses, particularly on the consumer side. They made significant revisions for auto loans, and so they actually said they expect losses on auto loans to rise this year. So we want to also pay attention to that. And also there's been changes in the banks subject to CCAR this year. Last year we had 35 firms subject to the stress tests. This year dropped to 19. The Fed exempted the firms between 100 and 250 billion in assets from this year's stress test, so it's a smaller sample. Only the largest banks. And finally, we'll be, there's obviously also an exemption of CCAR Qualitative for the largest firms, and so that's going to reduce uncertainty.
So what does that mean? What's CCAR Qualitative?
So CCAR Qualitative is an assessment that the Fed makes whether the firms have robust risk management processes in place to conduct adequate capital planning over the 9-quarter stress horizon.
I see. So that's been folded into the regular supervisory process?
That's right. From now onwards, for 14 firms of the stress test, it's going to be under their standard regulatory supervisory processes.
I see. So what will you be looking for on Friday?
Sure. I think the first thing we're going to be looking at is the peak-to-trough decline in capital ratios, stripping out the dividend payouts. So we want to see how the peak-to-trough declines compare against previous years and how it is impacting the volatility of banks' capital requirements, which is a topic these days. We're also going to use our own models to see where we can find the biggest differences between the Fed's own projections and their own projections and try to understand a little bit better the role of the scenarios in these year's stress tests.
Great. Thank you, Francisco.
Sure. Thanks, Bill.